Good evening, guys. Welcome to the session on standard costing. I'm just going to briefly show my face for those of you who don't know me, and then I'm going to switch it off, and hopefully that will help with the internet. The internet is somehow a little bit slow during this lockdown. So I'm Francois Steyn. I'm the MAC lecturer at the Baldy. I also lecture groups, and I've been lecturing management accounting for almost 10 years now, since I qualified as a chartered accountant. And I love management accounting because once you understand the principles, you don't have to memorize anything anymore. So I'm going to switch off my camera now. Hopefully you can still hear me, and then you can follow me on the slides there. And then hopefully at the end we'll have some time for questions. Because tonight we are, or this evening or afternoon, I should say, we're just going to chat about the super basics of standard costing. Because I know standard costing is like management accounting as a subject, one of those things that many students have a mental block against. I remember when I studied management accounting, I loved management accounting because I always tried to understand the principles. I was lazy to study, lazy to memorize stuff. And with management accounting, once you understand it, you are fine. But standard costing was one of those topics where I just memorized stuff. I memorized the formulas. I didn't understand it. I remember I couldn't help my friends with standard costing, and I just barely could do a question on standard costing, but somehow I made it. And then when I started lecturing, I had to understand it because I had to lecture it, and suddenly it just made sense. So hopefully tonight we'll just quickly chat about the super basics of what standard costing is and how you can understand the formulas so that you don't have to memorize them anymore. So I'm not going to go into the mix and yield variances and all of those funny stuff. Maybe at the end we can get to some of it, but this is more the super basics. Because I remember when they asked me to reconcile the standard profit to the actual profit, I did not know at all what they meant. But I could do it somehow because I memorized it. And to memorize stuff that you don't understand takes so much extra time and effort, and it's such a dangerous strategy. So before we continue, we're doing these free webinars to help you guys sitting at home now during the lockdown period. You don't have access to some of the support you used to have. So we try to help where we can. And we're also offering you a discount tonight. Well, it's until the end of April, 20% off any of our courses if you use this long promo code, Standard Costing 20. And from next week on in the webinars, we'll give away some free exam courses. So please attend those when you see the posts go up on Facebook. So before we go into the variances, what is standard cost? So I always try to see the bigger picture first. So from a financial accounting perspective, IFRS, IAS 2 on inventory, we should value inventory at cost, but we can also use standard costing if it approximates the actual cost. So we can use it to value inventory for financial accounting purposes. And I have seen that when I audited companies, they used standard costing because it's close enough to the actual. So it makes it much easier. But remember, we are management accountants, so we want to do something useful with standard costing or with whatever we do. So standard costing is used to control costs. So for instance, say a car manufacturer, I know some of the major car manufacturers in South Africa, some of the German makes use standard costing. And so if you have a process or a product where you have a specific specification and you know what it should cost to make the product, so how many parts do you need to use, how many screws, and how much paint, how many windscreens, how many wheels, you have a recipe for the product, you know what it should cost. It's like a target cost or the optimal, the cost, the should be cost. Then you can use standard costing. And then we can also use it now to control our costs. So as we produce the products, we can compare what actually happened to what should have happened. So I see the standard cost as sort of a target cost. What should it cost us? Now, this word, I'm going to highlight this over and over again because it just makes so much sense. What should it cost us? And you'll see later on why I stress this so much. I remember when I lectured face-to-face, I used to stand on the table or stand on the chair when I mentioned the should have cost later on. So what we have here on the screen is our standard cost per product. So the reason I do this is just to make sure of the terminology. So what are the cost elements when we cost a product? It's material, labor, well, direct material, direct labor, and overheads. And so it's 3 cost elements always. And our overheads can be variable and fixed manufacturing overheads. Now the standard cost, in this case, it's 100 Rand per unit. So remember, are we working per unit, per kilogram, per hour? There's so many different measures that can confuse us in a standard costing question. So be very careful and read very carefully. Often students fail questions because they didn't read carefully enough. It's not because they don't understand, they didn't read carefully enough. So the standard cost is 100 Rand, but let's see what it's made up of. We have this term standard quantity, so that refers to the amount of kilograms per unit, labor hours per unit. Variable overheads is based on something, and let's assume in this case it's labor hours, so again hours per unit. So standard quantity is the raw materials in kilograms, liters, meters per unit, and the hours per unit. Standard price is not the same as standard cost. Standard price refers to the Rand value per measure, so per kilogram, per liter, per labor hour. And then if we multiply standard quantity by standard price, we get the standard cost, and that will be per unit. So I know this is super simple and you all probably know this already, but don't get confused between standard quantity and standard cost, or standard price and standard cost. These are very important terms, and going forward, you need to understand when we mention quantity, it's kilogram per unit. And if it's price, it's 10 Rand per kilogram, not per unit. And only if we multiply the two, we get standard cost. Okay, so this is standard cost. So this product should cost 100 Rand if we do everything right. That's for 1 unit. Okay, now let's go into the financial year. We have our budget. We said we are going to produce 1,000 units. So we budgeted for 1,000 units. And this will usually be part of the given information. And it will cost us, this is the budget, remember, at the start of the period, 10,000 for material, 20,000 for labor, 30,000 for variable overheads, 40,000 for fixed manufacturing overheads. So total budgeted cost, 100,000 Rand. And then we look at the actuals. So let's first look at the timeline. I love drawing pictures to myself, and if you can draw a picture and you can picture what you see in the case study, then it's much easier to understand. So our original budget happens when? At the start of the year. So I always draw myself at that point. So at the start of the year, we are looking forward. We don't know what's going to happen. We think we're going to produce 1,000 units, and we prepare our budget, our original budget. And remember, if it's 1,000 units, we expect to spend 100 Rand per unit. So that's where our budgeted costs came from. Now, at the end of the year, we want to compare the actual to the budget. We want to calculate our variances to get all our marks, and in real life to see what went wrong to fix it. So at the end of the year, we saw, okay, we actually produced a little bit more. There was a little bit more demand, or we ran out of stock, so we had to produce 10% more. So we produced 1,100 units. And then we look at our bank account, and we look at our statement of comprehensive income, and we see, oh, we spent a little bit more on material, a little bit more on labor, variable overheads was spot on, and we saved a little bit on fixed manufacturing overheads. But in total, we overspent by 2,495. So that's not good. We spent more than what we budgeted for. But can we draw any meaningful conclusions from this? What went wrong? Remember, as management accountants, we use standard costing for a purpose. We don't just do it to see what is the difference. We want to know, why is there a difference? What can we do about it? What happened, and what should we do in future? Should we change our budget for next year, or should we change the way we did things? And if that is the case, what should we change? So we need to compare the budget to the actual. That makes sense. From normal budgeting principles, it makes sense. We need to compare the actual to the budget. Okay, so now remember, when do we get the actual figures? That's at the end of the year. That's when we know. So at the end of the year, we know we produced 1,100 units. We know we spent 102,495. and now we want to analyze the difference. Now, can we compare the costs of 1,000 units to the cost of 1,100 units? Can I expect you to make 100 more chairs using the same amount of wood? You're going to laugh at me because the chair is not going to look the same. So I have to allow you to use more wood if you produce more chairs. If we budgeted to make one chair and you made two, I have to allow you to use twice as much wood. So that is the key thing in standard costing, is we need to flex the budget. Now, flexible budget, some of you might be sitting there, you understand it 100%. So then the next 5 minutes is going to be a waste of time for you. But if you don't fully understand the flexed budget, please, this is the time where we can clear this up. And I know when I marked standard costing, even in third year and CTA, students often failed standard costing because they didn't flex the budget. They know they should, but then somehow in a standard costing, they just fail to do it and they lose all their marks. Not 1 or 2 marks, almost all their marks, because all the variances are wrong. So why do we flex the budget and what does it mean? Now, the original budget is, remember, something we dreamt up at the start of the year where we didn't know at all what's going to happen. The future is uncertain, it hasn't happened yet. So we thought we're going to produce 1,000 units and we know it should cost 100,000 Rand. At the end of the year, we have a much clearer picture because now we know we actually produced more. So we need to now recalculate what should it have cost us to produce 1,100 units. So if we had known at the start of the year we're going to produce more units, how much should it have cost us? And that's the flexible budget. That's all it is. So this is at the start of the year. The flexible budget is at the end of the year, but we look through the eyes of what should it have cost us. So let's look at material. We said it's going to cost us 10,000 Rand for 1,000 units. So our standard cost per unit is 10,000 divided by 1,000. That's 10 Rand per unit. And incidentally, I'm using the same numbers we had in the standard cost card. It's 10 Rand per unit. So our standard cost is what should it cost us. So if we produce 1,100 units, that is our actual units produced. Super important. This is where I stood on my chair always. Actual units produced. How much should 1,100 units cost in terms of material? Well, if we multiply it by the standard cost per unit, 10, we get 11,000. So we flexed our budget. We grossed up our budget by 10%. And you'll see for all the variable costs, we'll do the same thing. If our production is 10% higher, we have to allow for 10% more variable costs. It will increase in direct proportion and we expect it. It's not strange. It's not a variance. It's not something that went wrong. We should have spent 10% more because we produced 10% more units. And that is key. That is, if you understand that, then the rest is sort of straightforward. So you'll see each time we gross it up. So in a test, what would happen? What information will be given? They would either just give you the total costs and the units, and then the actual units produced. So you need to calculate the standard cost per unit. So you will say material 10,000 Rand divided by 1,000 units is the standard cost, 10 Rand per unit, and then you multiply it by the actual units produced to get to the 11,000. Or they could give you a standard cost card, and then you can take a shortcut. You can simply take the actual units produced, 1,100, and you multiply it by the standard cost per unit. So if you can't find the information that you expected, just look for other information that will give you the same amount. So remember, total rands divided by units will get you a cost per unit. Total rands divided by total kilograms will give you a cost per kilogram. And if you have the standard quantity per unit, you can multiply the cost by cost per kilogram by the kilograms to get standard cost. So play around with those figures. And that's why practicing questions are so important, because you'll see there's different ways that they can present the information. They'll either give you a standard cost card, which makes it quite easy, or they give you like a budgeted statement of comprehensive income, like this, the 10,000, 20,000, 30,000. So, and then you have to divide it by units or kilograms to get the components of the cost per unit. So practice questions. And also when you practice questions, don't look at the solution. That's a super dangerous shortcut, because your brain, if it sees the solution and it looks familiar, your brain will say, I know this, and you'll remember that you know it, and you probably don't know it yet. So practice without the solutions, make the mistakes, get stuck, sit there and wonder for half an hour, what do I need to do? Because then if you look at the solution, you'll say, this makes sense. This is not what I would have done. Okay, so let's come back to this. So now we know we can ignore the original budget because we've got a new budget, our should have budget. Because our should have is what we will be measured against. Our actual should be equal to our should have if we did everything correctly. We're comparing 1,100 units to 1,100 units, apples with apples. So now I'm going to throw away the original budget. And you'll also see at the bottom, before I do that, our should have cost is now higher, 106,000. So we actually spent less than what we should have spent. So it was not as bad as we thought. So let's throw away the original budget. So you'll see it's the same figures. We've got our flexed budget, our should have column, and based on how many units? 1,100 actual units produced. Super important. Actual, that 1,000 units is completely irrelevant for the variances. And on the right-hand side, we still have the actuals from our income statement or our bank statements. Now let's look at material, because your boss, and I always picture myself working for this company. I'm in charge of material. They said I should spend 10,000 on 1,000 units, or I should have spent 11,000 on 1,100 units. And now my boss comes into my office, he's pretty mad, and he says, you overspent by 495 Rand. What went wrong? So that's what we're facing here. Someone saw something went wrong, we overspent, we spent more than what we should have spent for the actual units produced. Why is that? And we have to answer that now. And they might ask you to calculate the variances. Most probably they will ask you to calculate the variances. And then they might ask you to give possible reasons. And we'll get to that a bit later on. So we overspend. What went wrong? Just think of anything that could have happened to overspend on material. Well, we could have paid more than what we should have paid. So we bought more expensive raw material. Maybe it was scarce, or there was some shortage and we had to buy from a new supplier at short notice, or maybe we broke some of it when we put it into production. It's maybe a very sensitive part, and as we used it, we were careless and we broke some of it, we had to use more. Or we dropped the can of paint, so we had to take out a new one. So there's wastage, unexpected wastage. Or in the case of the car, we ended up using more windshields because we dropped 2 of them and they cracked. So, but you can't say, it's maybe because we used more than what we should have used, or maybe we paid more. You have to pinpoint. So we have to somehow split the variance between the physical usage, the kilograms. Did we use more kilograms than what we should have? Did we waste? Were we inefficient? Or is it on the purchasing side? Did we pay more? Because remember, this could be 2 persons. There could be the factory supervisor that deals with physical materials, and there could be the purchasing department. Now, the factory supervisor will probably just say, no, they paid more than what they should have paid. Or the purchaser will say, no, they dropped some of the material, so that's why we overspent on material. But we can actually split this difference into the usage variance on this side and the price variance on that side. Now, there's lots of different words for it. We can call it usage variance, quantity variance, efficiency variance. It's all the same thing, but it's basically a quantity variance. Think of kilograms, hours, meters, liters. And then on this side, there's a price or a tariff or a rate variance, what we paid in rands. Now, how do we split this? Now, there's lots of formulas that you can memorize. And if you already know the formulas very well, then that's awesome. But if you sometimes can't figure out exactly, or you forget a little bit, this is going to help you to make sense of those formulas. And you can actually use this table to save time. I've always lectured using this table, and when I did standard costing, I also present this table as my calculation because it's so much quicker and easier. But you're welcome to use the formulas, and I'll show you how this is exactly the same. So don't freak out if you don't see the formulas yet. So how are we going to split? I'm just going to look at material for now. You'll see there's some more information here at the bottom. There's our standard quantity per unit and our standard price per kilogram. And here on this side, I gave you the actual kilograms that made up the 11,495. Now, this is information that would be given, or they could give you the actual price, R9.50, and you can calculate the actual kilograms. Now, if we look at the headings, you'll see in red, I've highlighted what each column is made up of. You'll see actual units on both sides. Remember, we're working with 1,100 units right throughout this example, actual units produced. But then the flexed budget uses the standard quantity, 1 kilogram, and standard price, 10 Rand per kilogram from the standard cost card. That's our budgeted cost per unit. On the actual side, obviously we need to use actual quantity because that's what we paid for, and actual price because that is what we paid the suppliers. So now we've got a big problem here, splitting this variance, because we've got the standard quantity versus actual quantity and standard price versus actual price, and we need to isolate the differences. So I'm going to put in a new column in the middle. We call this column the actual quantity from this side at the standard price from that side. So now this middle column is actual units produced again at actual quantity times standard price. And you can already start seeing where our formulas are going to come from. But now if we compare the difference on this left-hand side, the quantity variance, we have actual units produced, no difference. Standard price, no difference. The only difference here is we use standard quantity and actual quantity. So can you see where the formula comes from? You remember the formula for the usage variance is our standard quantity less actual quantity, that's the difference here, times there's our standard price on both sides. And there we've got our formula. But now you can see where it comes from. Let's look at the price variance. We've got actual units produced, so no difference there. Actual quantity, no difference there. But in green here, we've got standard price versus actual price. So price variance equals standard price less actual price multiplied by, and now we can't remember which one. Here it is, actual quantity. So you can see the formulas are actually in this table. So now it's as simple as calculating this value in the middle, and then we've got our variances on either side. If the should have is more than the middle column, then it's favorable, and if the actual is less than the middle column, then it's favorable again. So let's look at it at this example. How do we calculate? See if you, maybe we should try this. See if you can calculate the actual quantity of input at the standard price that goes into this cell in the middle. What should go in there? So forget about any formulas. Just think, how much did we actually use in production? Here's the value. It's 1,210 kilograms. It was either given or you could calculate it using the actual price. So actual quantity of input at standard price. Now, if we use kilograms, we need to take the standard price per kilogram. So what is that? That's this 10 Rand here. So remember, it's actual usage of kilograms. We're not going to put the actual units, or we're not going to do it in units. We want the actual physical kilograms, because on this side we need to compare should have kilograms versus actual kilograms, and on this side we compare should have price versus actual price. So what is the value in the middle? It's 12,100. So on the next page I've cleaned this up. So there's our 12,100. This is actual quantity of input at standard price. And now you see the difference here gives us our quantity and price variance. So the quantity variance is 1,100. That's the difference between the 11,000 and the 12,100. Why is it unfavorable? Well, we should have spent, this is our benchmark, our target, 11,000. But the actual quantity was more, so we ended up spending more, so it's a negative variance. Or you can just say left-hand side minus right-hand side, it's a negative, so it's unfavorable. Now remember, you need to show a U or an A for adverse to get your full marks. On the price side, again, the should have price said at the actual quantity, it should have cost us 12,100, but it actually cost us way less. How much less? 605 Rand less. Why is it favorable? It's because we spend less than what we should have spent at the standard price. Now we can also put this in formulas. There's the usage formula. So we know standard quantity less actual quantity. So what is the standard quantity? It's our 1 kilogram per unit. So actual units produced times 1. That gives us, that gives us 1,100 kilograms, less the actual quantity, 1,210. So the difference, that's what I scratched out here. The difference is 110 kilograms. So we used 110 kilograms more than what we should have used. And we know it's both at standard price. So times 10, and that's where our unfavorable variance comes from. It's the same thing. So you can memorize this, but you can see how dangerous this is, because if you by accident used actual price there, then the whole thing is wrong. Or if you mixed this, you said AQ less SQ, the difference is correct in absolute values, but you'll have a positive. So you have to think about what you're doing. So I never memorized which one comes first. I always calculated the difference, and then I asked myself, did we use in kilograms more than what we should have used or less? If it's more, bad. So then it's a negative variance, unfavorable. That's how I always figured it out in the test myself. Then the price side. So our formula here, if you memorize the formula, you know it's standard price less actual price times actual, that should be quantity. So 10 Rand is our standard price. Actual quantity price we had to calculate. So it's the total Rand value divided by the total kilograms. And that'll give you 9.50 Rand. So already we can see this is a favorable variance, because we should have spent 10 Rand per kilogram, and we actually only spent 9.50 Rand. So it's a positive variance, favorable variance. We multiplied by the actual quantity that was given. So yeah, so this is so whether you do the formulas, and if you've been doing it, if you're in second year now, it's easy to switch over to this table method early on, because see how beautiful this is in the table method. The flexed budget, every single value here is calculated the same way. Okay, fixed overheads not, because that doesn't change. We don't flex a fixed cost, but the variable costs are all the same. It's the standard quantity per unit, or standard price per unit, standard cost per unit, not quantity, not price, standard cost per unit times actual units produced. So all three are the same, and the actuals are simply given in the scenario in most cases. And then it's simply a matter of calculating the three values in the middle, or more if there are more costs, and then deducting the middle column from the left, the right from the middle, and you have all your variances. So you can literally save 10 or 15 minutes by doing it this way. But a big but here, you have to show your calculations. You have to show how you got your values. And the key thing is, if you don't flex your budget, all the quantity variants are going to be incorrect, because this value, the flexed budget, is incorrect. So practice this if you want. Otherwise, use your formulas, but please make sure that when you do the formulas like this, that you at least understand where it comes from. We are isolating, in the case of the quantity variance, we're isolating the quantities, the standard versus actual quantity, and the standard price remains the same. In the price variance, we isolate the price, standard price versus actual price, and the quantities stays the same. Okay, so that's the basic cost variances. Now, I want to quickly chat about this reconciliation, because I remember this reconciliation was something I just did not understand. I didn't know at all what they were doing here. Now think about budgeted profit. What is budgeted profit? It's simple. Budgeted profit is, we see that in absorption costing, absorption and variable costing. We see it in budgeting. Budgeted profit is simply our profit at the start of the year when we prepare our budget. It's our budgeted sales less budgeted cost of sales to get budgeted gross profit, less budgeted other expenses, budgeted net profit. So budgeted profit shouldn't be something difficult. It's at the start. That's our original budget. And in our example, we used 1,000 units. Actual profit is again simple. It's our actual units produced and sold, and that's at the end of the year. So actual is right there. And everything in the actual profit is just actuals, except what is the one thing in the actual profits that is not actual? opening inventory and closing inventory. Remember, we're using a standard costing system, so our opening and closing inventory will be at standard cost. So if you prepare a absorption costing income statement, you'll have sales, less cost of sales, but the opening and closing inventory will be at standard cost. So that is one thing in the actual profit that is a little bit funny. But actual profit is simply our profit at the end of the year. Actual units and our actual costs spent, our actual price per kilogram, our actual kilograms used, etc. But what is this standard profit in the middle then? Because I remember they asked us to reconcile standard profit to actual profit, or sometimes budgeted profit to actual profit. And I always thought standard profit and budgeted profit must be the same thing. Standard profit is what we know now as should have. How much should our profit have been if we knew that we're going to produce 1,100 units, our actual units produced? So we're standing at the end of the year when we calculate our standard profit. It's our actual units produced, but for everything else we use our budgeted cost per unit, our standard cost per unit. So this is our should have profit. What should our profit have been? So you'll see all the cost variances will be the difference between standard profit and actual profit. Our standard profit is our flexed budget. So that's why I always try to picture the timeline, and I try to picture this table. Whoops. This flexible budget is our standard profit. So then you may be asking, but why is there a budgeted profit? The only difference between budgeted and standard profit is our sales volume variance. And you can see that 1,000 units to 1,100 units is our sales volume variance. So when they ask you to prepare the reconciliation from budgeted to actual, you'll start with budgeted, add or deduct the sales volume variance, and immediately give you standard gross profit. And then you'll list the selling price variance and all the cost variances. And that should bring you to the actual profit at the end. Let's just see. Okay, so there's our timeline again. So now, let's quickly chat about the fixed costs before. I think we're almost at the end now. So if you have any questions, pop it in the questions there. I'll see if I can get to it now. Otherwise, if you have to leave, pop a question in there and maybe I can answer it in the next 10 or 15 minutes. So if you look at this messy table here, let's just quickly chat about the fixed costs. If you want to use the table, let's chat about the fixed costs, because that is the one variance students often struggle with. So our flexed budget, we said we don't flex fixed costs because as we produce more, our fixed costs should stay the same. And this is true if we use the variable costing income statement. Remember direct costing. So then we only have one difference. If we use a direct costing or variable costing or marginal costing statement of profit or loss, and in standard costing, because remember in standard costing they can ask you absorption costing, the trickier one, or marginal or variable costing, the easier one. There's only one difference. We call that a spending variance or sometimes expenditure variance. And in this case, it's 1,000 Rand. We spend 1,000 Rand less than what we budgeted for. And so that's a favorable variance, and we call that a spending or expenditure variance. Easy. But now in absorption costing, do you remember we have another variance? We've got that fixed manufacturing overhead volume variance. So we have a volume variance and a spending variance. So where does that come from? So let's go back to our, when we use this table, and that's why this is so awesome. When we flex the budget for variable costs, flex the budget for fixed costs as well, and write in there 44,000. So it's 40 Rand per unit multiplied by 1,100 actual units produced. So that's 44,000. So you might be asking, why do we flex the fixed cost? What is this 44,000? Where do we see that in absorption costing? Do you remember, what do we do with fixed manufacturing overheads in absorption costing? We calculate a predetermined overhead allocation rate, which is our budgeted fixed manufacturing overheads divided by our normal capacity or our budgeted units. So what is that in this example? 40,000 budgeted fixed overheads divided by 1,000 budgeted units. So that is 40 Rand per unit. And if we allocate that to our production, we allocate it using the actual units produced. So this is all absorption costing. What do we get? 44,000. So this 44,000 is not our actual, it's not our budgeted, it's our allocated fixed manufacturing overheads. Do you remember allocated fixed manufacturing overheads? So we've got budgeted, that's the 40,000. We've got the actual, that's the 39. And then we've got this 44, which is the allocated fixed manufacturing overheads. So in this flexed column, we've put the allocated. And now, how do we calculate the volume variance and the spending variance? We put the original budget in the middle, 40,000. Forget about this headings here. This is completely a separate variance. This is just to show you how I calculate it. So now we have on this side the volume variance, and on this side we have the spending variance. So you can see the spending variance stayed the same. It's 1,000 Rand, and it's favorable because we have original budget of 40,000, actual of 39. So we underspent by 1,000. So that's the same as our direct costing income statement or variable costing. The volume variance now is the difference between our allocated and our budgeted. So that's 4,000. And is it good or bad, favorable or unfavorable? Well, 44,000 less 40,000 is favorable. Now, how did we get this to be a favorable variance? So picture this. We budgeted to produce 1,000 units at the start of the period. Where's our timeline? 1,000 units. And we said it's going to cost us 40,000. And now we actually squeezed out 100 more units. So we got out 100 more units from the same fixed cost, the same capacity, the same factory. 100 more units, and fixed cost shouldn't change. And if we multiply that by our 40 Rand per unit, the standard cost, we get our 4,000 volume variance. And why is it favorable? Because we squeezed out more units with a fixed cost. And that's why this 4,000 is favorable. If we produced less units, this would have been less than 40,000. So then this would have been an unfavorable variance, and that would have been bad because we got less units from the same fixed cost. And that's how I always remembered our volume variance. Okay, so we've come to the end of tonight. I know this was the super basics, but please, this you really need to understand very well before you move on to anything else. And what I really want you to do is to practice lots of standard costing questions without the solutions, because the only thing now that makes it more difficult is the way they ask it. They present the information in funny ways. Either they give you the standard cost card, or they give you income statements, budgeted and actual, and you have to go and play around and see if you can calculate the necessary or the relevant information to either put in your formulas or to put in these tables. And then in third year and CTA, they'll break down the usage variance into a mix and yield variance, which you can also use a table for. And I think I actually go and check out our Tabaldi YouTube channel. There's some free videos there as well where we go through some of the topics. Also on our Tabaldi Facebook page, we've been posting free online videos from our classroom. So see if you can find some of the, can't remember whether I put mix and yield in there. But if you have any questions on tonight, please email us at queries@tabaldi.com and we'll get back to you. And if there's any other topics you'd like to be covered in either costing or financial management for next week, please again message us at queries@tabaldi.com and we'll see what we can do as a free session for next week. And then remember that standard costing 20, the promo code for 20% off. And then from next week on, we will give you a free, one of the lucky viewers, a live viewer, will pop a quick question that everyone has the answer to, and the one that responds first will get a free exam course of your choice for any of the undergrad exam prep courses, where we cover 2 full exam papers, how to read it, exam technique, and then in detail solutions, video solutions on the whole paper and how to mark it. So thank you for joining me tonight, and good luck on your side, and please chat to us at queries@tabaldi.com. Cheers.